Today, we are looking at PepsiCo, one of the world's largest consumer staples companies. PepsiCo generates revenue from two major segments: beverages and snacks. On the beverage side, PepsiCo owns iconic brands such as Pepsi, Mountain Dew, Gatorade, and Tropicana. On the food side, it owns Frito-Lay, which includes brands like Lay's, Doritos, Cheetos, and Quaker. This is a key difference compared to Coca-Cola. While Coca-Cola is almost entirely focused on beverages, PepsiCo has a highly profitable snacks business, which provides more diversification and stability. Snack sales tend to be less cyclical, have strong pricing power, and generate very consistent cash flows. PepsiCo sells its products globally through supermarkets, convenience stores, restaurants, and vending channels, benefiting from massive scale and distribution. Thanks to its diversified business model, PepsiCo combines defensive characteristics with long-term growth, making it one of the most stable companies in the consumer staples sector. Despite its strong and diversified business model, PepsiCo faces several important risks going forward. One key risk is pressure on consumer spending. While snacks and beverages are everyday products, higher living costs can still push consumers toward cheaper private label alternatives. Another challenge is input cost inflation, especially for commodities like corn, potatoes, sugar, and packaging materials. Although PepsiCo has strong pricing power, margin pressure can still appear if costs rise faster than prices. PepsiCo is also highly exposed to foreign exchange movements and emerging markets. A strong US dollar can negatively impact reported earnings, even when underlying demand remains solid. Long-term health trends and regulation represent another risk. Governments continue to target sugar, salt, and processed foods through taxes, labeling rules, and marketing restrictions. Finally, competition remains intense. Coca-Cola dominates beverages, while private label snack brands continue to improve quality and pricing, increasing competitive pressure across categories. Overall, these risks don't threaten PepsiCo's survival, but they can influence short-term growth, margins, and valuation. Over the last 5 years, PepsiCo has faced several execution challenges that investors should be aware of. First, rising input costs significantly pressured margins. While PepsiCo successfully passed higher costs to consumers through price increases, this strategy eventually slowed volume growth in some categories. Second, the company became increasingly dependent on pricing rather than organic volume expansion, which is not sustainable long-term if consumer spending weakens. Third, supply chain disruptions during and after COVID affected production efficiency and increased operating complexity. Finally, international markets delivered mixed results, with currency headwinds and uneven demand growth in emerging regions. These issues didn't break the business, but they did limit margin expansion and highlight the importance of execution discipline. Despite recent challenges, PepsiCo has several strong long-term opportunities ahead. One of its biggest advantages is its highly diversified business model. Unlike Coca-Cola, PepsiCo generates a large portion of its revenue from snacks, led by the highly profitable Frito-Lay division. This provides more stable cash flows and reduces reliance on beverages alone. PepsiCo also benefits from strong pricing power and a globally recognized brand portfolio, allowing the company to protect margins even in inflationary environments. The snacks category continues to grow faster than beverages, creating a structural tailwind for PepsiCo's long-term revenue growth. Emerging markets represent another important opportunity, driven by population growth, rising incomes, and increased consumption of packaged foods and beverages. Finally, PepsiCo is investing in innovation and healthier product offerings, adapting to changing consumer preferences and long-term regulatory trends. Together, these factors support resilient growth, strong cash flow generation, and long-term shareholder value. Looking at PepsiCo's long-term performance, the stock delivered an average annual return of 6.9% over the last 10 years, including dividends and dividend reinvestment. This reflects a combination of stable growth, strong cash flows, and reliable shareholder returns rather than aggressive capital appreciation. PepsiCo currently trades at a P/E ratio of 26.6, which indicates a premium valuation relative to the broader market. However, this premium is partly justified by the company's low volatility, with a beta of 0.42, making the stock significantly less volatile than the market. The EV to EBITDA ratio of 12.7 suggests the stock is fairly valued for a high-quality consumer staples business. Net debt to EBITDA stands at 2.3, which represents a manageable and well-controlled level of leverage. From a profitability perspective, PepsiCo generates a ROIC of 17.21%, showing efficient capital allocation and strong returns on invested capital. Margins remain solid, with a gross margin of 54.27% and a net income margin of 7.82%, reflecting pricing power and operational resilience. Overall, PepsiCo appears to be a high-quality, low-risk business trading at a premium valuation, offering stability rather than outsized growth. To conclude, PepsiCo currently offers a dividend yield of 4.08%, which is attractive for income-focused investors. However, it's important to highlight that the payout ratio stands at 104.55%, meaning the company is currently paying out more in dividends than it earns in net income. This does not immediately signal danger, as PepsiCo generates strong and stable free cash flow, and temporary earnings pressure can inflate the payout ratio in the short term. That said, this metric does put dividend sustainability under closer scrutiny going forward. Future dividend growth may slow unless earnings and margins improve. PepsiCo remains a high-quality, defensive consumer staples company, supported by strong brands, diversified revenue streams, and resilient demand. From an investment perspective, the stock may appeal most to investors seeking income and stability, while accepting limited growth potential and elevated valuation risk. Thank you for watching. This video is not investment advice. If you enjoyed the content, please like, subscribe, and let me know in the comments. Do you own PepsiCo shares, or do you prefer Coca-Cola instead?